Joining us now are iCapital's Anastasia Omaroso and Charlie Bobrinskoy from Ariel Investments. Anastasia, you don't think we're going to see a violent correction, despite what we saw today? Maybe another 100 points on the S&P? I think you're saying to 3,900. Why not? Especially given how tepid both Home Depot and Walmart were this morning on the consumer.
Sure, John. Well, I think we were definitely due for a pullback. If you just looked at the stocks a couple of weeks ago, we kind of saw the overbought signals, and we knew that a lot of CTAs were in the long trade, and or at least they were short covering. And now this is sort of unwinding. I think that's why we saw the mini violent day that we saw today. But the reason I don't think we necessarily need to see an imminent and violent pullback to 3,600 or maybe even lower, like some people are calling, is because the fact of the matter is this economy is either soft landing or there is no landing. I mean, most consensus estimates coming into the year were calling for a negative 0.1% GDP. You know what the Atlanta Fed is tracking now? 2%, over 2% for this quarter. So this is an economy that seems to be withstanding almost 5% rates because consumers are resilient, corporations are resilient. And by the way, all that infrastructure stimulus that got put into the system, that's starting to work its way through the system. So I think, yes, the Fed may be raising rates another 25 basis points and consensus may be pricing that in. But this economy can actually withstand it. And that's why we may not have to price in a 14 or 15% multiple that would be more consistent with a recession.
All right, Charlie, I want to get your thoughts on this. Hard landing, soft landing, no landing. I mean, we've seen a pretty dramatic move in rates. The 10-year, 3.95 today versus where it was just 5 days ago, around 3.75. And now you see stocks following suit. Your thoughts?
I think there's general consensus about the economy. I think where the problems are coming is not being able to predict the Fed. And we were getting to a point where we thought the chance of the Fed making a big policy mistake was coming down. Many of us have been saying we don't have an overheated economy. We have an economy growing modestly. We don't have an overheated consumer or overheated labor market. Wages are going up less than inflation. But we do have a Fed that got made to look ridiculous by saying that inflation was going to be transitory when it clearly wasn't. And so there was this risk that the Fed was going to do something stupid. And then we got some very good inflation numbers, and we got some things that made it look like the chance of that was lower. And unfortunately, we've had sort of 2 or 3 bad inflation numbers in a row. And so now a Fed policy mistake is back on the table. And there's a reason why people say don't fight the Fed, because if the Fed wants to cause a recession, they can.
So Charlie, what do you do here if you're looking at your portfolio? I know you're at Ariel, so you're in favor of value stocks, but what does value mean in this kind of jumbled up market?
It means that our companies are making money today as opposed to 30 years from now, is what a lot of growth and FANG stocks do. And so they are less affected by higher interest rates. And so that's one of the great important rules of the last 40 years is interest rates have been falling continuously since 1980. And that's been a huge, huge tailwind for growth stocks. It's been a tough time to be a value manager, but our companies are making money now. And so we think we will be less affected by this upturn in interest rates, which could get worse. I mean, again, that's the big headline. There are a lot of people on the Open Market Committee who want to see higher rates, who think that we have this big risk of inflation. And so they are intent on cooling what they call an overheated economy when I just don't see an overheated economy.
Yeah.